start buying gold, building, go on a holiday, one-bedroom apartment outside somewhere in the West. You've got to stack gold, preserve wealth, and build arbitrage and optionality. We'll win by being gold and precious metal investors. That doesn't mean we've won completely.
There's no question gold is becoming tokenized. I'm paying BlackRock and JP Morgan a 50 basis point management fee.
You don't live in a world where the dollar can go up like the milkshake theory boys on crashing debt markets.
Rick Rule talks about an 8% decline in the dollar every year, and quite frankly, I think that's generous.
The indicators of real distress is the bond market itself. So I watch the 10-year and the 30-year US. It wouldn't surprise me if the Cayman Islands basis trade is also propped up on the primary dealer banks lending, doing the day-to-day off of maybe yen borrowings as well. You know, that little island of 7.5 billion GDP is maintaining between 1.8 and 2 trillion. That's more than Japan. The communism is coming. That what's going on in Europe is crazy. The trust needs to return. And I think in all these instances, these are attempts to regain trust, both in the revelations, like we're arcing back to truth with what happened over 19, and in money with China going the gold vaulting and knowing that gold is fundamental to trust. Deep down, you and I both know gold is money and everything else is credit. And I think the smart minds know that they've got to win that game and establish that credit, that real money for any form of trade system to have the same trust or better trust than the failing one that we're busy witnessing.
Yeah, there's no question gold is becoming tokenized. I can tell you, I know this to be true. My feeling is that it's moving more towards the institutional to challenge the ETF market, redeemability, transparency, the ability to post for collateral, all of these things you don't get with the ETFs, plus you're paying BlackRock and JP Morgan a 50 basis point management fee. I do think tokenization is coming. But I guess on a bigger level, why gold? Why, again, going back to the first question, everything's okay. Why are we seeing governments accumulating gold the way that they are if the dollar system is supposedly perfectly healthy? And do you think, I guess even more to my own curiosity for what you're going to say, do you think gold is becoming infrastructure or is it becoming an asset? I think that's, to me, the bigger question. Is it an asset to own or is it part of a coming infrastructure?
Gold becoming infrastructure would be far more consequential than another bull market headline. Francis Hunt notes that tokenization could transform gold into institutional collateral while exposing weaknesses in ETFs. Government accumulating gold only makes sense if monetary trust is being rebuilt for something beyond today's dollar framework. For investors, the key question is whether gold is insurance or a bridge into the next financial architecture. Next, Francis Hunt exposes why tokenized gold could challenge ETFs.
That's an interesting question. Is it an asset or infrastructure? I tend to say it's ultimate money and it's preservation of value. So it's a wealth preservational tool that will transcend systems dying. I refer to it as the golden arch, from the rickety old train onto the new monorail. Even though the old train is going to go off the cliff in the end, it will carry whatever wealth, whatever you put into it while on the old system, you will get to transport over to the new system. However, there will always be institutional traps as well, and I do consider tokenization of your wealth as part of declaring your wealth for all to know, and tax attacks vectors and other forms that could be subsequently weaponized against you in lieu of gains. It's quite ironic and a slight departure maybe from your question, but it's amazing to me that in a fiat debasement world where inflation is policy by all central banks and inherently our buying power is being eroded away, that there is such an evil tax, such as capital gains, on the basis that it's not like for like. You've been put into monkey money. You're a monkey on a grease pole, and you're slipping down perpetually. And to have retained value creates an artificial impression of actually being given some windfall you just didn't deserve that deserves to face taxation.
Gold can preserve purchasing power through monetary upheaval, but ownership can still become a vulnerability. According to Francis Hunt, gold's enduring value comes from surviving failing monetary systems, while tokenization could create new reporting and taxation risks. That creates a contradiction. Technology may strengthen access while making wealth easier for authorities to identify and tax. For savers, preservation means little if rules change. Next, Francis Hunt unravels how retained value can become a tax target.
And this is the thing that most warrants challenging, that the proliferation of fiat is the debasement of fiat, and that a capital gains tax on something that retains value is actually an immoral tax against somebody who just wanted to preserve their wealth. And that is an even bigger question. I want to be in the court case that wins out over anybody that buys a gold ounce and preserves their wealth is not to be taxed on gains that were mainly a function of monkey money doing what monkey money does, slip real fast down a greased pole into the crocodile pit. So for me, it always remains a perpetual asset. Unfortunately, it's one that's likely to face corrupt, immoral attack vectors such as taxation. And whilst we'll win by being gold and precious metal investors, that doesn't mean we've won completely. We've got a lot of battles to fight against people that don't want you to win, that actually wish to reduce us all to serfdom and aim to strip us of all our assets. That's the larger game, a global communism almost by de facto. And it's our goal as libertarians to assert private property rights, assert the immorality of excess taxation on a debasing fiat that's about to go into its most steepest convexity curve of descent. And this is what we're seeing with the debt rates going up. We're seeing debt debasement simultaneous representative to fiat. And those that attempt to separate a UST from a dollar must remember that they're really basically the same thing. A dollar is a fiat today, and a one-year T-bill is $1 in a year's time with a rental agreement attached to it. You don't live in a world where the dollar can go up like the milkshake theory boys on crashing debt markets.
A rising gold price can disguise the fact that the currency underneath it is losing purchasing power. What Francis Hunt is highlighting is that nominal gains can be misleading when the measuring stick itself is deteriorating. A capital gains bill may capture appreciation on paper while ignoring currency debasement underneath it. For savers, the real danger is protecting wealth only to discover the tax system treats preservation as profit. Next, Francis Hunt exposes why debt and currency cannot ultimately diverge.
You're not going to have that divergence occur for any sustainable period. They, in the end, if they're going down hard enough, they all go down and they drag us down. And this is our goal. This is our great challenge. It's the asset of the ages, but we've got to protect it, and we've got court cases to win on tax law.
Yeah, it's a very interesting point. You know, I mean, if that really were to be talked about more, it would the realization that holding your wealth in dollars is akin to holding a melting ice cube, and holding the asset that supposedly pays no interest, that is a barbarous relic, has outperformed everything by just doing nothing. And that's what gold has done for thousands of years. It retains your purchasing power in the face of falling fiat. Rick Rule talks about an 8% decline in the dollar every year, and quite frankly, I think that's generous. So therefore, for those of you that have held gold for 10 years, you know, the dollar has lost, in that case, 80% of its purchasing power as gold has continued to move up about 9.9% per year for the last 25. It's outpacing, just barely, the fall of dollar. You don't own it to become wealthy. You own it because it is wealth that has outlived everything the world's ever thrown at it. And I think your point is exactly spot on, Francis. So let me ask you one more question before a lightning round.
The safest asset in nominal terms can become the riskiest asset in real terms when the currency steadily loses value. This is where Francis Hunt's thesis shifts from chasing returns toward measuring wealth against purchasing power. Gold does not need to outperform everything. It only needs to preserve what the dollar cannot. For older investors living on accumulated savings, that distinction can determine whether their portfolio actually survives inflation. Next, Francis Hunt reveals why gold's real purpose is preservation, not speculation.
I've never done the lightning round before, but I thought about it with you because the way you answer questions is so interesting. I'm going to just get 1 or 2 word answers out of you after this question. And so this last question would be, I mean, if all these pieces are moving at the same time and the system is quietly changing underneath us, guys like you and I who spend hours every day digging well outside the mainstream see this, most don't. So I'll ask you, what is the moment or signal that you're watching for that tells you this has gone from a little by little slow transition, something the average person can no longer ignore when your neighbor, your brother-in-law, the guy down the street says, damn it, Francis, I should have listened to you a long time ago. What do I do now? So what is that moment, do you think, that wakes up the masses?
For smart, alert people like your good self and your viewers, the indicators of real distress, which will invariably be part of the fiat and debt-based distress, because that is the foundation and that is where we're most overextended, is the bond market itself. So I watch the 10-year and the 30-year US, but I've also known for being the person in 2021 said the Japanese market's going to go from 0.3% to 6% on the long end. No one was talking about Japanese debt. They'd been for years sub 1%. So I watch the USD JPY, and that's not just because of recent events.
The public usually notices a monetary crisis only after the bond market has already delivered the warning. As Francis Hunt notes, the 10-year and 30-year Treasury yields matter because sovereign debt sits beneath almost every financial asset. His focus on USD JPY also highlights how a seemingly distant currency can transmit stress through global leverage and carry trades. Investors waiting for headlines may discover the market signaled trouble months earlier. Next, Francis Hunt unravels the stress indicators hiding beneath calm markets.
This is the stress indicators I've given as my Francis Hunt crib sheet for stress indicator observation is the yen pair, because of the carry trade and because of the amount of borrowing we suspect has in fact taken place. It wouldn't surprise me if the Cayman Islands basis trade is also propped up on the primary dealer banks lending, doing the day-to-day lending rates off of maybe yen borrowings as well. That little island of 7.5 billion GDP is maintaining between 1.8 and 2 trillion. That's more than Japan. It's almost double Japan's rates, according to the BIS, of Treasury holdings, which is about the equivalent of me being on a $250,000 gross income with costs and expenditures still to have to pay, but owning a 63 million bond portfolio. Just to give you some proportionality to the perversion that is the Cayman Island basis trade and the bid under the Treasury market. So everything I'm saying here says this is an entire facade. You're being sold the Hotel California, but in actual fact, there's nothing behind the building. They've got this beautiful frontage, and behind it, there's these metal poles holding it up. They are literally propping up the debt market. You can't sell, as we've just discussed, for if you're a big nation, and Europe is doing something similar. So it's not just an American, it is a Western hemisphere.
A $7.5 billion economy, supporting roughly $1.8 to $2 trillion in Treasury holdings, should immediately make investors question what the headline numbers are hiding. Francis Hunt's argument suggests the Treasury market may depend on leverage structures that appear stable only while funding remains available. That means safe debt can contain hidden fragility, when enormous positions rely on constant liquidity. For conservative portfolios, the real risk may be the plumbing, not the advertised yield. Next, Francis Hunt exposes the basis trade supporting this facade.
And I fear the communism is coming. That what's going on in Europe is crazy with von der Leyen, the clampdowns, the reading of private messages. Everything socially is moving towards the totalitarian type lockstep environment. So we've got some problems coming down the chute, which is another reason why people should contemplate multi-jurisdictional homes and existences. I know that sounds very affluent. Start buying gold, building, go on holiday, one-bedroom apartment outside somewhere in the West. You've got to stack gold, preserve wealth, and build arbitrage and optionality, because the West isn't going to be the haven and the high living standard part of the planet that it once was. It's turning in terms of trend, and many people go, well, where do you go? What do you do? Sometimes you just have to recognize when you have to leave and go somewhere else and start searching. There's no Narnia, unfortunately. But these are the decisions people are having to start thinking about. So back to the indicators, though, because I diverged a little bit on you, and I apologize for that.
That's okay.
The yen, the debt markets, and I will tell you, because of the hyperscaling and the chips, I've added the KOSPI, which is a less, primarily 2 stocks versus the 15 stocks that I've mentioned and MAG 7 of the SPY. So it's already shown some real fragility. I think it rolls harder sooner.
When governments tighten financial and digital controls, geographic diversification becomes a wealth issue rather than a lifestyle luxury. This is where Francis Hunt's thesis shifts toward optionality: gold, alternative jurisdictions, and assets outside one financial system. But investors should separate legitimate diversification from extreme predictions. The measurable warning is market fragility, particularly concentrated equity exposure. If liquidity turns, correlations can rise quickly, and diversification can vanish when needed most. Next, Francis Hunt reveals why the KOSPI could become an earlier warning than Wall Street.
That'll be an early indicator for a great unraveling. And you mentioned private credit. And just a final point on that, because I've gone long form on you there, is it was so interesting what you said about private credit and being locked out against getting your money back. In a soft sense, in a soft way, Besant's activities with Japan is a soft lock. Hey, let's give you an alternative to that, where you can't get your money out. And we are going to see much, much more of this tendency of what BlackRock, Blackstone have been doing on their private credit funds, and more of that in terms of the debt markets. And I think we're starting to see that. Besant did a soft lockout of Japan on Treasury selling. That's a conversation you won't get to hear, I won't get to hear, but I would imagine that is a conversation that was had.
Treasuries, still risk-free?
Without a doubt, not so. High risk.
Yep. That's contrary to what the Main Street would tell us. This is what you call a real opinion, not just one that is manufactured stock from the Main Street. Gold, money or collateral?
Money of the ages, but also can be collateral.
All right. And if gold is money, what is silver?
It's money too. It's just lower denominational for the physical aspects, which is very convenient. And it has an even more extreme, I would say, supply-demand related issues. So it's a high beta to the upside to gold.
I agree.
Private credit can look stable until investors discover that liquidity was never guaranteed in the first place. According to Francis Hunt, soft lockouts and restrictions around debt markets reveal how quickly access to capital can become conditional. The contradiction is striking. Treasuries are marketed as risk-free, yet the surrounding financial system increasingly depends on mechanisms that manage who can sell and when. Investors should question liquidity assumptions before chasing yield. Next, Francis Hunt exposes why gold and silver occupy a different monetary category.
Bitcoin, money or speculation?
I think it's absolutely a fairy tale, none of the above. It's virtual fantasy.
Right on. China, competition or architect? Well, that's a competitor or architect.
Competitor or architect. It's certainly a competitor to the USA, as a more so than it would be. I would describe it as an architect, but they are building very unique things with great design. So if we refer to that as architecture, it's certainly propensity to be both.
Yeah, a competitor, an architect competitor. Japan, problem or first domino?
It's certainly a problem, but it's not Japan is not a sovereign independent nation. It's America's problem, because if Japan has to do certain things, they are going to cause contagion in the West. So it's a domino almost, a potential domino.
Right on. Just three more. Fed, in control or trapped?
Hopelessly cornered.
Right on. I agree. Inflation. Do we call it inflation or is it better to call it debasement?
I think debasement is more accurate for the era that we're in. It's hopelessly understated, and it is the primary tool of impoverishment of the people, is how I'd encapsulate it.
I agree. Last question, and you can expand as long as you want on this. And thank you for your candor, Francis. It's always cool talking to you. You're one in a million. The biggest mistake investors are making, what is it?
The most dangerous label in this debate may be safe, because Japan, inflation, and monetary policy can transmit risk across borders. What Francis Hunt is highlighting is the difference between nominal stability and structural resilience. Calling currency erosion. Inflation can soften the reality that purchasing power is being transferred away from savers. For investors, the question is not which asset sounds safest, but which survives monetary stress. Next, Francis Hunt unravels why debasement may be the more revealing word.
I think you and I have both positioned ourselves around that. And the biggest mistake is what you have is, historically, you judge your future by your history of experience. People can't conceive events so extreme and so large that there's been no precedent for it in their lifetime, and possibly even in their parents' and their grandparents' economic lifetime. So overall, I am saying that the extent of devaluation, loss, and hardship and turmoil that could be perpetuated, and the social unrest and the scale of this, is going to make the US depression of the 30s look like a cakewalk. I think if you multiply it by 10, you universalize it through all the Western world, and you pass at least half of it on to the rest of the world for knock-on effects, you'll start to understand the economic problem, the reaction, and the subsequent tokenization digital world solution that's going to be uploaded on us. So from that point of view, I'm sadly dystopian, while a general optimist for my own and people around me's quality of life. I have to say, environmentally, we're probably going to go through real economic history of the ages, that for centuries they'll be wondering, what the hell were those people thinking?
The biggest portfolio mistake may be assuming tomorrow will resemble yesterday simply because markets have behaved normally for decades. This is where Francis Hunt's argument suggests investors underestimate regime change because their experience provides no reference point for extreme monetary stress. History shows that once confidence breaks, correlations and liquidity can behave very differently. That makes preparation more important than prediction for anyone protecting decades of accumulated wealth.